like I travel all over the world every day, and but I wasn't too helpful with that one. But the point is that people are waking up, and this program is among maybe 20 or 30 programs that are telling the people the truth and putting them on guard, and goodness knows we are making a difference. We are. And it's a very, very strong, very strong imprint that we're making, and there are those who are listening, and those who are listening, because they're going to be able to hold their assets together, are going to be able to help other people who didn't understand or are less fortunate, particularly people within their family. People know that all we're getting out of Washington is gobbledygook, and we have another actor like Mr. Reagan in the presidency, and very glib, articulate, and he's just doing what he's told, like every other person who's put up there in that position. And people know that. They know they're not getting the skinny, the straight scoop out of the media that is, we'll call it mainline media. And so we trudge along. As far as gold is concerned, I think today was miraculous. I thought it was fantastic. And we've got these meatheads again with their charts, waves, and cycles telling us we're going to have another correction. And this time it's going to be 700 or 800 or 900. Absolute insanity. They still don't get it that the markets are rigged. And they can't use their charts because they don't work. Any chart is worth his salt. All he has to do is look at a gold chart. And if you turn it upside down, it's a perfect head and shoulders. Turn it right side up, it's a reverse head and shoulders. The most powerful of all charting formations. And it's leading to a breakout. And it's going to be very, very quickly when it happens, extraordinarily strong and powerful. And, we may go straight to 2,000. I mean, who knows? It's all there, everybody. And we're in for the long term. Don't worry about trading. Don't try to pick the spots. Don't try to play the market. Just buy. You're not professionals. And they're only right 53 to 55% of the time. Think about that. And you, who's taking and washing, or working on a rocket, or taking somebody's tonsils out, are trying to figure out when's the best place to buy, give it up. You don't stand a chance. When the pros can only be right 53 to 55% of the time. Think about it. So get your tail in here. Gold's in the outside access market. They're trying to push it down. It was down $22 earlier. And, in fact, when I took the prices down at 3:30 this morning, gold was off $12.90. And the access market right now is off about $7, which means nothing because it's a thin market. And it can be whatever they want it to be. And we might get a little weakness tomorrow, and then gold's going to take off again. And it's not going to stay here too long. And even if it reversed, where's it going to go, to 950? I mean, big deal. We get down to, 9 in the outside month, 978 this morning. And it came right back again. And too many buyers. So we got a powerful thing going here. And the news is still dreadful. The head of the Treasury doesn't know what to do. He's running around in circles. So this day it's this. The next day it's that. The Dow hasn't closed this low since May 7th of 1997. Some serious stuff we're looking at here. And who told you about that? 5 years ago, Bob Chapman and the International Forecaster told you. Told you when to get out of your houses, when to get out of the market, when to buy gold and silver, and goodness knows how many other things. And all I can say is I'm blessed. And you're better off for it. And we're going to make some mistakes along the way, but overall, we'll do very well. Questions?
Ready for some questions?
Yes.
I got a lot.
Incidentally, the financials were not down today. Most of them were up because we're not going to have nationalized banks. How laughable.
Yeah.
Nationalization is really consolidation and privatization because the banks are going to be owned by the Fed. So the financials are going well. You know, we're short. That means the stock's going to go down. Citigroup at 48. It's trading at $2 today. And that means the people who shorted at 48 are up 46 points. I mean, that's unheard of. And for those of you who don't get the forecaster, we have closed positions on the shorts. There's about 6 of them where people made 95% on their money. I don't think there's ever been a newsletter in history that's had so many winners as we have. I mean, between the coins and the stocks and the short positions and all the other recommendations, I don't think there's anything close to it. And we're very happy that we've been able to help a lot of people, and I sure hope it continues. And we're very happy so many people have become subscribers. Please go ahead, Melody.
Thank you. Historically speaking, are periods of high inflation or hyperinflation measured in months or years before they end? And what are some of the variables that affect the duration of a hyperinflationary environment?
Well, heretofore, you must remember that in former hyperinflationary times, the debt burden all around for the Fed, for the government, for business, and for individuals was nothing like it is today. So let's go back to recent times. Let's go back 28 years to the great bull market in gold and silver of 1977 through 1981, and then the fallout, which was actually mostly caused by money central banks, now called legacy banks in New York City, who were lending the cash flow that was coming from the Middle East from oil to others, usually sovereign governments throughout the world. And I can never forget back in the 70s that the president of Citibank at that time, I forget his name, he said sovereign countries don't go bankrupt. Well, he knew darn right well that that wasn't true because we had plenty of bankruptcies during the 30s, especially in South America. And so the banks like Citibank lent piles of money to places like Argentina and Brazil, and they couldn't pay it back. And there was a great crisis. And gold was flying. Inflation was 14.5%. And they didn't lie about inflation. They just started to in 1981. And so what Paul Volcker did was he took the interest rates to 21%. And you could get away with doing that. Today, if you did that, you'd have terrible dislocation, but it must be done. But they haven't done that. It's just like having a fire in the stove. They open the door up and threw more logs in, or coal, or whatever you're cooking in there. And it's not going to work. And historically, it has never worked. And it's been tried hundreds and hundreds of times. And it's not worked. And so we're seeing hyperinflation. earlier on, up until about 8 months ago. It's dropped down to between 9 and 10%. Government admits to about 4%. And as soon as the monetization of the money that the Fed and the Treasury have created essentially out of thin air starts to hit the financial markets, we will get hyperinflation again. And then after that, in a year or 2 or 3, whatever it is, and nobody knows, finally, borrowers will stop borrowing. And when that happens, the game's over. And so we're going to have hyperinflation, and then we're going to have deflation. But as I said earlier in the conversation,